to Net Lease TV. Welcome to Net Lease TV. It's Friday, March 19th, and it's awesome to have you on the show. We've never really had a chance to talk, so we're killing. And by the way, I have my glasses on because my eye got a little irritated because of my contact lens. But you know, you're always cool no matter what. If you're cool, even if the sun isn't shining, you know. So anyway, that's why I have my glasses on today.
Thanks for having me, Chris. I'm very excited to be on Net Lease TV for the first time.
Awesome, Randy. So tell me, I know that you're a longtime Net Lease all-star. How did you get involved in Net Lease? Because I read your publications. You guys have some great research data, and I really enjoy seeing that coming out all the time. How did you originally get involved in Net Lease? What year and what got you involved in it?
I appreciate the kind words on the research. I'm glad you read it. So I'll date myself and tell you I graduated college in 1991 and went to work for a Chicago-based firm, which has been acquired twice since, which is now JLL through acquisition, and was running the AT&T account for the Midwest, which is all the industrial facilities in the Midwest where all the service vehicles go at the end of the day, kind of was running that portfolio. And as part of that, you know, we did some sale leasebacks and we try to buy some locations from certain people to expand or do a variety of things. And, you know, all these people who were older told me that, look, love to sell to you guys, but I have this low basis. I've owned it for 30 years since the 50s. And, you know, I can't afford to sell because I can't afford to pay the capital gains tax.
So I said, let me back you up, Randy. What year was this that you started?
1991.
So 91. Wow, you were in there early. I started at about 95, so you really had a pretty good jump.
I'll use the word veteran versus old.
I don't know if you're older than me. I'm just turning, I think, 54, 55. I don't know. I forgot. I stopped keeping track. Are you younger or older than me?
I'm a little younger by a few years.
Wow. So you were just a pup when you started. And how old were you when you started in business?
21.
Whoa, you were young. Did you graduate college early?
No, I graduated at 21, so almost 22.
You were a young. All right, go ahead. I just wanted to clarify that.
No, sure. So in order to get these people to sell these properties to AT&T, I had to find them replacement properties so they wouldn't pay any taxes. Then I started to realize that, look, this is kind of a little bit of a niche business, and it happened to me over and over again. And, you know, these AT&T properties were, you know, single tenant net lease. It wasn't an industry, as you know, like it is today.
Right.
But a lot of people would call me and try to buy these properties and said, look, I think it was a interesting niche. So, you know, at the grand old age of 26, I thought I understood what was going on. And, you know, would get into the net lease business. I had a bit of a clientele from these AT&T properties and, you know, thought I would do it for a while. And, you know, I thought it would be a few-year run. And, you know, here I am. 2021,
Randy,
still doing it.
Were these build-to-suits or sale leasebacks back then?
Most of them were sale leasebacks. Again, older properties, and a lot of the landlords had, you know, been former developers, and they just owned this. They had a portfolio of these things, and you know, they weren't really sure what to do with them, but they knew they couldn't sell because they weren't going to pay the taxes on it.
Why do you think in the old days you saw more sale leasebacks than today you see the build-to-suits? Is it just a different, you know, from a corporate level? Do you think it's just a kind of a different frame of mind that the CEOs are thinking about, hey, we don't want to do sale leasebacks? Or do you see the sale leaseback kind of coming back in vogue where, you know, companies can monetize their real estate and extract some money, get their stock up and exercise those stock options?
Yeah, I mean, look, I think the problem with sale leasebacks today is interest rates are too low. You know, so I think these companies can borrow very cheaply, and it's more expensive for them to do a sale leaseback today. You know, back then interest rates were a lot more expensive, and you know, I think if we revert again to higher rates, we'll see a sale leaseback market that's more vibrant again. But you know, now people think you go from 1 to 1.5, and that's a huge move. But historically, 1.5 is still on the very, very low side. So I think until we hit
I'm glad you brought up interest rates, because we got the 10-year Treasury at 171 as of the 19th today. It was at 134. We're up a big 37 basis points. Do you think that cap rates are sticky? In other words, is there a lag period that the cap rates will adjust, kind of with the 10-year Treasury yield? Or what's your opinion on that? Do your research.
Yeah, look, I think that there's a lag, and it could be a year lag up to a year, because the supply is so reduced. Obviously during COVID, not a lot of new developments kicked off, and so we just don't have a lot of supply today. If we were in kind of an equilibrium and buyer and sellers were the same, obviously interest rates move cap rates up. But the supply demand is so out of balance, I think it's going to take a lot longer than it traditionally takes to catch up.
So you're seeing a lack of supply of what type of uses would you say have the least amount that are available for sale in net lease right now? Is it fast food? Is it pharmacies? What is it? What are those short supply areas?
It's not so much a specific category. It's long-term leases, which is 15 years plus, and it's new development, which is hand in hand with the longer-term leases, meaning there's a lot of 5 and 10-year leases out there and a decent supply of 10 to 15, very few 15 plus. Again, we're just a low cycle kind of in the development pipeline. We have limited sale leaseback volume, and a lot of people are kind of have 15, 20-year leases, want to hold these things or refinancing them out. It's the shorter term leases that are in abundant supply, and the longer term stuff, not so much. Hopefully with COVID going in the right direction, a new development pipeline kicks off. But again, that's probably 6 to 9 months away from where we are today.
Do you think FASB had anything to do with that when they stopped saying, hey, you can do off-balance sheet financing? Do you think that caused companies to reevaluate the lease terms that they wanted to do? Do you know anything about FASB?
Yeah, I do, and I think it definitely had a impact. I mean, I don't think it's the only impact out there today. Again, I think it's companies are constantly changing their business models, and some are focusing on asset light. Other people have different costs of borrowing. I mean, there's just a lot of things to go on. And FASB is certainly one of them. But again, I think that what's driving them at the moment is look, there's a limited supply, so it's a tenant's market as far as sale leaseback terms are concerned. And companies like Walgreens are choosing lower lease term because basically they can, and you combine that with, development, which kind of halted for, 6 to 9 months to a year, and, terms are shrunken as a result. Obviously if the market goes in the other direction.
Here's something to think about that I thought about. I'm a CEO of a company, and I've gotten stock options. I'm out of the market, right? All my objective is get that damn stock up, right? So let's say that, I'm Starbucks, and a store is $3 million. If I could sell the store, and pay 6%, what is that? 180,000. And I take the 3 million, I divide it by $1 per cup of coffee. That's 3 million cups of coffee. And then I sell that 3 million cups of coffee at $2. Now my 3 million became 6 million. And if I do that multiple times with multiple locations, my earnings per share goes up, my stock goes up. Now I'm in the money. I can exercise my option. Bango. Is that why companies are kind of doing the sale leasebacks? Try to get their stock up. If you're the CEO, doesn't really care about the real estate. All he cares about is exercising his options and getting in the money on the stock. Would you agree with that?
Yeah, but I'm not always sure it's the CEOs making the decision. Typically what we find is activist shareholders, specifically hedge funds, and some board members who want to drive kind of this asset light model. And they're forcing the CEO's hands into, look, we're not in the real estate business. I want you to shred real estate. I want the company basically to consist of a brand, and all their assets, move them elsewhere. We shouldn't be in the real estate business. So again, we're finding shareholders are driving it, not necessarily CEOs, because CEOs, they see the value in it, but some of them, aren't real estate background, and some of them are old school and want to have control of real estate forever. even even though leases are long term with options. But we find shareholders are the ones that come in and say, look,
Okay,
there's
shareholders.
there's 3 billion of real estate on your balance sheet. I don't understand it. I'd rather there be 2 million or 1 billion. Why don't you do something to lighten that up? And I think, as people's competition does that, it forces them to do so. So, I think that's more what's driving it than just the CEOs. But yes, there are certainly CEOs that are gaming earnings occasionally. I just don't think they're the only driver of this.
I mean, I think you could also use it as a defense for a hostile takeover. If somebody's trying to hostilely take over your company, you could start to sell the real estate to get the stock up. There's a couple different reasons why I think you would do a sale lease back. Let's transition a little bit. What are you seeing as the contrarian uses? I mean, right now, I was thinking hotels, start to dip your toe in the hotel market, gyms, hotels, sit-down restaurants. If you think that coronavirus is going to get better, and that could be an area that's pretty distressed. Are you seeing any hotels where you can get into a deal where the owner of the real estate is leasing to like Marriott? Are you seeing any LA Fitnesses, any 24-hour fitnesses? What do you see as the contrarian uses right now that have been really beat up because of coronavirus? And do you think, is that a falling knife at this point? Or do you still feel that you would wait before you start dipping your toe into those areas, those uses of net lease?
We don't really do much in the hotel sector, so I'm going to punt on that part of the question. In regard to other contrarian uses, I mean, I think you got to bifurcate them, which is, look, there's movie theaters, which I think people are concerned about, and their attitude is, even if the COVID situation resolves itself, have people's habits change long term for theater viewing? And I'd argue that they have. We just don't know to what extent. So most people are playing wait and see with movie theaters, which is probably the right move. On the other hand, gyms, which are still out of favor as well, I think there's a much better case for, because in general, I think even if people go to the gym less and work out a variety of things, I think it's largely a communal activity, and certain things that they're doing, like Peloton or Mirror or other things, can be used in conjunction with the gym. They don't have to be one or the other. So, they may change the way they use the gym, but I'm pretty sure people who like the gym will continue to go in, and the health trend in America is certainly still going to continue that direction. So I think there's value in gyms. I think LA Fitness is a good one. I think Lifetime Fitness, etc. So again, I think that gyms is probably an undervalued sector at the moment. Movie theaters is probably a wait and see, and I'll leave it for you for hotel expertise, because I can't comment on that.
Can't comment on the hotel area. How about in the movie theater area? Is AMC good? What tenant guarantors do you like in movie theater, or is that something that, again, kind of like the hotels, you don't really dabble in that area?
Well, again, I think most people, AMC is certainly a good brand and certainly has sustainability here. Again, I think a lot of investors that I spoke to are like, look, let's see what their numbers look like in Q3 and Q4, so I can understand what the business model of movie theaters is moving forward. Again, certain low rent ones in great areas are still going to be great investments, but I think there's a lot of ones, on the bubble, or maybe that had, problems prior, and this accelerated them. Maybe some, movie theaters typically aren't freestanding, that are attached to enclosed malls, but there's a few, at least on ground leases, and I think their business model is changing. So again, I think movie theaters are, have always been specialized and always kind of had a limited buyer pool. And I think, everyone's a little hesitant at the moment to see where we stand. But I think the green light's on for gyms.
Green light's on the gyms. Woo! Yes, I was looking at some stats, maybe on your website. I don't know where I saw them, but they said that United States has the most gyms. I don't know if you're aware of that. We have a lot of healthy people here now, and especially in California. I mean, you get into the higher end areas, Orange County. I was at Fashion Island, and everywhere you look at Fashion Island, they have pictures of people working out, and people are buying that. They're buying anything to do with health today is so huge. Beverly Hills area, high-end areas, people really believe in health and gyms, and they want to live a very healthy life. What about office buildings? Are there any opportunities in office buildings that are net leased to big companies like Coca-Cola, Nestle, or do they just owner occupy their real estate more or less?
Well, look, there's certainly, obviously office and industrial deals together don't equal the number of retail properties out there. So they're smaller sectors as far as number of properties. Dollar wise, they're much more similar because the ones that are out there, huge Amazon distribution facilities, or large office buildings leased to Microsoft or someone, are big dollar value. Again, not a huge market in the under $15 million space, which is primarily where we're involved with. But office is, again, another category people are very hesitant on because, I think most people believe now that, people will maybe come to the office 3 days a week, but not 5 days a week anymore. 2 days remote, 3 days at the office, so kind of a hybrid model. And if you're doing a hybrid model, there could be 20 to 40% less space required by these big companies. So people are a little bit nervous in committing to that space, knowing that, these buildings are what was a full building before, maybe 75% occupied tomorrow because of the demands of the tenant. So again, I think it's another category where people are going to kind of wait and see is when people go back to work in the third quarter or whatever it may be. What occupancies look like, how tenants rearrange, their square footage per person. I think that's an open question.
So Randy, on our previous panel, all-star panel with Jesse Lyman, I don't know, do you know Jesse? And Carly Iacono is now with CBRE. Jesse's with Marcus and Millichap out of, I think he's in New York. And this was probably August. They said that, the new darling again is Walgreens and CVS since coronavirus has hit. Basically, they've really gone up because of the vaccination of people, the reliability of being able to go into your local pharmacy. Are you saying the kind of the same thing? I know my attorney, Yvette, has sold quite a few of them. I don't know if you know Yvette Flores, but they seem to be selling very quickly now. The Walgreens are starting to really fly off the shelf again. Do you attribute that to the coronavirus? That for a while there was a little skepticism that Amazon could come into that market. What do you see with the pharmacies now? What's your opinion?
Well, look, it's clearly gotten better as I think people realized, it's essential, and during a pandemic or other challenged time, people flock to these locations and they realize their investment grade and they realize the kind of need for them. And B, I think obviously with the actual vaccine distributions, Walgreens has done a great job. But I mean, look, the drugstore sector is so strong that, we're not selling a lot of Rite Aids, which were previously fairly challenged. Now there's demand for Rite Aids once again. It's kind of a vibrant market for the better ones.
So let me stop you right there. I know Rite Aid, at one point, Walgreens was kind of trying to buy out Rite Aid, and then they bought a lot of their locations, a lot of their distribution centers, and that kind of threw Rite Aid a curveball. Also, I think in one of the presentations I saw on health, they have a large amount of debt coming due in 2023. Are you aware of anything like that? Did they use some of those funds when they sold to Walgreens, some of their locations, to pay down that debt?
Yeah, look, Rite Aid's financials have gotten better over time, but they're clearly, the distant third in a two-person race at the moment. But that doesn't mean they don't have good individual locations, or if they ever reorganize, that your locations wouldn't go south. And some of them is just plain real estate plays. So, obviously with Rite Aid, you need to be a little bit more skeptical from an investment perspective. You need to be looking at, obviously, the rents and, rent to market. But I think for a lot of Rite Aid locations, they're pretty strong performing locations. They don't have a lot of competition. And even in a downward event for Rite Aid, I think a lot of the individual locations will do well. So again, if you're looking for higher yield in the pharmacy space, they're your best and only bet. Whereas you're looking for more safety, obviously you're going to gravitate towards Walgreens and CVS. It's a different kind of investor who's speculating into Rite Aid.
The one trend we're seeing, Randy, out here in California is this eviction moratorium with apartment owners. And there's a lot of new red tape on apartment landlords. So they're rolling out of their apartments if they have a real low basis, and they're heading east because they don't want the hassles of deadbeat tenants, leaky faucets, and they're rolling into net lease. But at the same time, they're kind of like scratching their head going, what area do I go into? What use do I go into that I'm not going to be disrupted? That my net lease isn't going to, be like the buggy whip that becomes obsolete. What are the uses that you think have a long runway that will be, will not become obsolete in the future, that will continue for the next 10 to 20 years? Because that's what you're kind of betting on a long-term deal. You're saying what innovation is not going to come in and start competing with my use?
Yep. So look, I think the two obvious suspects are restaurants and auto related. Very few people think that, QSR and casual dining are going to be encroached by e-commerce. Likewise, I think, Take 5, Jiffy Lube, Valvoline are pretty safe as well. So again, I think people are looking for automotive. I think people are looking for restaurants. I think, obviously drive-through restaurants preferably. These are things which kind of have a long shelf life. And I think, I think the best thing the pandemic did was accelerate trends that were already in place. So I think it kind of showed people that, things which have drive-throughs and things which were freestanding are greatly superior to things that are in centers and, don't have the same kind of access to vehicles. So I think you're going to see a lot of tenants, leaving enclosed malls, and I think a lot of tenants leaving strip malls to move to freestanding. They want the drive-through, they want the visibility, and they want the ease of access for the customers. So I think this is about to be a great run for net lease. It has a lot of tenants that were previously in enclosed malls, like everyone from Sephora to Gap to SoulCycle to Lululemon to Apple, are going to leave those malls and go to have freestanding locations. So I think there's a lot of freestanding opportunities.
That's huge opportunity then. So maybe we'll see more supply of uses that were in the malls will now transition to single tenant, is what you're saying.
Very much, and I think
investors.
I think it's a great driver. It's names that people are underinvested or not invested in at all. It's new uses for former facilities. Again, I think it's going to be a great thing for freestanding buildings. And I also think a lot of tenants who are in strip centers like Dunkin' Donuts or Panera realize that, look, I need to drive through. I can't stay in a strip center. I need a freestanding location. I need one, maybe two drive-through locations. So I need a freestanding, even if it costs me more in rent. And previously, people have been more concerned with the rent. Now people are more concerned with the business model, emulating things. And they've seen a lot of success from people who've had 2 and 3 drive-through, like a Portillo's or like a Chick-fil-A. I think people, even McDonald's, I think people think, one drive-through isn't enough. And if I don't have one, then I need to change my location to get one.
You know what I see is going to be a hot market? I love the coffee. Woo! Coffee Bean and Tea right here. Dutch Brothers is just rolling out. They're just on fire. We just did an episode. I don't know if you saw our Dutch Brothers episode in La Quinta. That was a really fun episode on Net Lease TV. And they plan to do 300 stores, Dutch Brothers. That is a really hot concept. They're kind of like the In-N-Out of coffee. I think that Starbucks probably will get a clue and start to do more drive-throughs just to compete with Dutch Brothers, Coffee Bean and Tea. That could be a hot market coming up. Let's transition again. 1031 exchanges. Now, did you send your senator a letter? Because I did. I just can't believe, there's like the trickle down. So many jobs, us as I'm a loan broker, you as an agent, broker, architects, contractors, ICSC, whatever it may be. 1031 exchange has created a lot of money for a lot of people. What are your thoughts on that? And I hope that, Randy, you're telling your clients, get involved, send your senator a letter that you oppose any changes to the 1031 exchange.
Yeah, so yes, I have sent my senator, congressman, etc., letters in proponent of keeping the 1031 exchange. And I
Okay.
think that we're likely okay. I don't think 1031 exchange will go away or be modified by itself. The concern is that it gets swept up in some large legislation, and it's just a part of a much bigger bill that you can't carve out or take away. Again, I think people understand or are better understanding the merits of the 1031 and how many people it affects. Everyone from, less trades hurts everyone, including local tax revenue, transfer taxes, on down to title agents, attorneys, brokers, mortgage companies, lenders, etc. So there's a huge people that are impacted. So I think the real estate community can do a good enough job protecting it if it's only geared towards 1031 exchanges. Where they may not be able to protect it is if it's some part of some larger bill eliminating, hundreds of little tax changes. That may be harder to stop. It just says, look, anybody over $400,000 can't get any tax breaks or something of that nature. That's my bigger concern. And that I can't speak to the political environment that could pass that. But we're going to focus on if it only comes for 1031, can we stop it? And again, I like our chances. I like our chances on the small game. On the big game, it's just an unknown at this point.
We had a proposition out here in California. I was on the Andrea Kaye show in San Diego. It's a radio show here. And we opposed that. I told everybody, send your senator a letter. And that proposition basically said they were going to reassess net lease properties, which would have been really catastrophic for tenants, because in a triple net deal, the tenant pays the property tax. We just barely opposed that and won in the election. So I think it's so important as real estate professionals, principals, investors, we really need to get involved in the political landscape today. How about events? I saw today in the Wall Street Journal, Vegas is going to be the new Roaring 20s. They're already starting to plan I think it was a concrete convention in Las Vegas. Vegas is really starting to open up again. Hopefully, even the New York ICSC, I don't know if that's going to happen in December. I don't know if ICSC is going to happen in May of 2022. Do you plan to attend some events if we start to open up again? And which ones, or do you know?
No, look, I think conditionally, I think that the third quarter, I think it looks pretty favorable for in-person events. I mean, I think 20% of the population as we speak today is vaccinated, and it's going at a 1% a day, which puts us into, the June-July timeframe for the majority of the country being vaccinated. Once that occurs, I think people will gravitate towards, in-person events. So again, I think that towards the end of the third quarter, for sure, in the fourth quarter, in-person events will be happening again, maybe slightly differently or some rules or, less density, but I feel good towards the end of the year. Obviously, nothing's probably going to change in the next few weeks or few months. But again, after 4th of July, I'm pretty optimistic about the virus being under control.
So I say we get a good lunch together. Let's spend some more time together. I'd love to do. We're closing 2 7-Eleven gas stations, and I'm doing a 30-year AM fixed for 20. We locked at 4 1/8. And I've got to send my stuff to settlement. We should close at the end of the month. And then the second one, it's 2 brand new 7-Elevens, spanking brand new 7-Elevens with gas. Beautiful stores. One in Texas, one in Florida, and we'll close the second one next month. And then, we're working with a lot of exchange buyers, just kind of on a big picture basis. What we've found, Randy, is that when we start to meet with these 1031 buyers at the very beginning, they're going to go with lesser credits, higher cap rates, and there's kind of a learning curve. They don't really understand it, but as time goes on, they get more educated and they start to kind of lean towards better credits. As you know, 7-Eleven is AA- rated. So originally this client was going to go with some lesser credits and then kind of moved up the credit level and rolled into these 2 7-Eleven deals. Do you represent buyers or are you representing more sellers?
We focus more on sellers. I mean, the problem we have is that, obviously in a market like this, there's a lot of buyers around, maybe too many. Some are more real than others, and some are more realistic than others. In a market that good supply is in large demand, we've done a lot better on the property side of things. But we certainly represent some buyers, but more selectively than
More selectively.
More selectively, we're trying to focus on listings, but clearly, buyers are a share of our business, just not the majority of our business.
Are your sellers local area developers, REITs, institutions, individual families? What would you say is kind of most of your sellers that you're working with today?
Mostly high net worth individuals and family offices.
Family offices.
That tends to be our bread and butter. We do less work with institutions. Most people want, most are kind of, older generation, high net worth people who bought a portfolio or are looking to buy a portfolio of things as they head towards retirement and passive income, or people who are making changes for estate planning. That's a big part of our business.
So Randy, what are some deals that you've closed in the last 6 months? Were those all cash? Was there financing involved? Who are the credits, the uses? And do you have anything that, is close to maybe closing in the next 3 months, or that are kind of starting to gel and come together where you have signed LOIs and contracts?
Yeah, we're pretty busy in kind of a high volume little group. We close about 2 to 3 deals a week.
My gosh, you're a busy man. Two or three deals a week?
Yeah, so we're doing a lot of volume. We did 174 deals last year. So we're doing a lot of volume. Certainly, we're seeing a lot more cash deals recently. But like I said, Walgreens, CVS, and Rite Aid have been a big share of our business as of late. Banks have done a good share of business, and QSR and casual dining, auto parts. All the usual suspects are having their day. Obviously, things like movie theaters, we haven't done one recently. Gyms, not one either. But we're hoping they're coming back. And again, I think that as the year goes on, people are going to start taking more risk in this market. So it's not just going to be long-term investment grade, it's going to be other things as well. So we think the second half of the year is going to be pretty strong volume. We think the first half is going to be fairly muted.
What's that, the third quarter?
The third and fourth quarter are going to be fairly strong. The first and second quarter will be okay, but not great. Again, this lack of new development is really hurting the supply. So, if there was a pipeline of all new development properties, fairly easy to move at this point in the cycle, but there just isn't enough supply to go around.
There's just not a supply. So we got a supply issue. I think the demand, you'll see the stimulus. And if the Federal Reserve is buying the 10-year Treasury, although the rates have jumped pretty significantly, I don't know that, the fear on Wall Street is that the Fed loses control and they're not able to stamp down the 10-year Treasury. You have a lot of fiscal stimulus. I do think that with all the fiscal stimulus, there's probably a lag. Second, third quarter are going to be huge. It's going to be a lot of growth as long as the vaccines work. That's why they're saying in the Wall Street Journal today, it's going to be like the Roaring 20s in Las Vegas. But again, we need the supply there. You need the supply to mop up that demand. And if it's not there, so anyway, I appreciate you being on Net Lease TV, Randy. Appreciate all your expertise. You do a great job. If somebody's looking to buy a net lease, or agents out there, how can somebody contact you, send you a LOI, get started with you to get the process going?
Best place is to go to bouldergroup.com, visit our contact page, or send me a connection on LinkedIn. Those are probably the 2 easiest ways to get a hold of me.
Awesome. I'd love to finance your deals. The door is always open. If you have buyers that need financing advice, I'd love to do it. Our viewers can call me anytime, Marabella Commercial Finance at 760-479-0800. For more Net Lease TV, you can access our website, www.marabella finance.com, or just Google Net Lease TV. And please like this video, subscribe to our channel, punch that subscribe. I want you guys to get involved. We want to hear your remarks. We're trying to make this very interactive. We'd like to hear from you. If you have any questions for me about net lease financing, acquisition, refi, cash out, takeout, construction, just comment below here in YouTube. Or if you have any questions for Randy, what uses he likes, what do you think cap rates are going to do? What do you think supply of net lease is going to do? Definitely leave your comments below. So Randy, thank you so much for being on Net Lease TV. It's been a pleasure, and have a great day. Signing off, Net Lease TV, Randy and Chris Marabella. Thank you, Randy.
Thank you for having me. Look forward to working with you.
Have a great week, and let's stay in touch.